Yep. Still don't like these video messages. But anyway, here we are. Okay, so chapter one. Um, there's really three things that we want to take away from chapter one. The first is we want to understand the end game in this class. Like the whole reason we're taking this class is to learn about the financial statements. And in the book, the financial statements are usually the last thing that they talk about in chapter one. But to me, it's helpful to talk about the financial statements first because it's helpful to, for me anyway, it's helpful to understand like where are we going? What's the point of this? So I'm going to start with what the book ends with, which are the financial statements. The second big thing that we need to understand is the accounting equation. And we're going to use the accounting equation throughout the entire semester. And so I'm going to create a second video after this that talks about the accounting equation. And then the third takeaway is really kind of like the heavy lifting, where we're going to observe business transactions, get those transactions into the financial statements. Sorry, get those transactions into the accounting equation. Then once everything is in the accounting equation, we're then going to create the financial statements, right? So the way that I kind of see this, these first lectures, we have these business transactions. We want to then take all of those transactions and get them into the accounting equation. And I will go over the accounting equation soon. Okay, but that is the accounting equation. Then once everything is in the accounting equation, we create the financial statements. Okay. And so I think it's helpful to just start with the financial statements so we get a better sense of where we're heading. All right. So there are four financial statements. The first is the income statement. And the income statement, that is, right? So I could be running a business. I could be selling hoodies for some extra money. It's like I don't make anything as an instructor. So I wrote a book and I sell hoodies with the artwork from my book on the artwork of the front cover on my book. Actually, I guess it's this way. Really cool. But anyway, the money that I make from selling my hoodies, that would be reported on the income statement, right? So the whole reason that we want to create these financial statements is that we're not really wanting to go to a bank or to an investor with a bunch of random information. Investors, lenders, they want to know a couple of things straight off the bat. And very quickly, they want to know just like, how successful are you at running your business, right? Are you making money every year, right? Is the price that you sell your hoodies at, is it more than what it costs to make them? And are you making any money? So the first financial statement that we're going to talk about and learn and understand is the income statement. And the income statement has really more or less, it has two components. Okay. It starts with revenue. Okay. And revenue is the money that I earn from selling my hoodies, right? So if I sell a hoodie for $50, the revenue, the $50 that a student would give me, that I consider that revenue. It's the money that I earned from selling my hoodie. And then we have expenses, and expenses are all of the costs that I incur to create my hoodies. And I can keep it super simple, right? But if I paid $20 for my hoodies, right? So I'm going to pay somebody to make my hoodies. I pay $20 and then I sell it for 50. The $20 that I'm paying to have somebody make the hoodie is what I refer to as an expense. The difference between the money that I get from a student from selling my hoodie, the revenue, relative to the money that I spent making the hoodie, my expenses, the difference of those two is what I refer to as net income. And net income is something that most companies want to know. Sorry, most lenders want to know. Are you making money? Right? We don't want to be selling hoodies for 50, or we want to avoid an instance where we're selling hoodies for 50 and it costs us $55 to make, and therefore we have, right, a loss of $5. We want to avoid that as much as possible. Some companies purposely do that. We'll get into that later, but that is the income statement. Okay. The second, the second financial statement that we want to understand is what we call the statement of retained earnings. And the statement of retained earnings, this is kind of a throwaway financial statement. Investors don't really want to know a whole lot about your retained earnings, but we need to create the statement of retained earnings in order for us to then create the third financial statement, okay? Which investors really do care about. So the statement of retained earnings, this is essentially all the income, right? All the net income that I've kept in the business over the life of the business, year after year after year after year. So on January 1st of every year, I'm going to have a beginning balance. And in this example, I could just assume that um, my beginning balance is $4,000, meaning I've been selling hoodies for a long time, and I'll just give you a heads up, there's no fucking way that I've earned $4,000 selling accounting hoodies. It will never happen. Um, but anyway, that aside, we're going to start with all of the earnings that I've captured and retained throughout the life of the business up through January 1st of this particular year. And then I'm going to add the net income, right? The net income that I earned this year. And in this particular example, right, we can ignore the scenario where we lost money, but I could have a year where I only sell one hoodie. I am selling accounting hoodies, so it's not that unreasonable to assume I only sell one a year, right? So I would add my net income for this year, and then I'm going to subtract what we call dividends. And dividends are just a payment that we make to ourselves if we're the owner. Okay, so think about it. I have $4,030 available to me, and I want to take a vacation. I want to go to, I don't know, Costa Rica. My wife and I are gonna like tell the kids we're going out for milk, and then we're just gonna like take off to Costa Rica for a week without the kids, right? One of my kids lives in Chicago, and the other one goes to college here at the College of San Mateo. So I really don't think they'll mind, but I'm definitely not taking them on vacation. Okay? The money that I want to use to go on vacation, I'm taking money out of the business and I'm going to use that to go on vacation. Now, it's not an expense. Even though I'm using money and it's from the business, it's not an expense because going to Costa Rica has nothing to do with selling hoodies. It's not a normal activity associated with my business. So dividends are the distribution of cash to the owners of the business. Okay? And in this particular example, I'm just going to make it up. I'm going to say, hey, I pulled $2,000 out of my business, and therefore I have ending retained earnings. I'm going to abbreviate of, what would that be? 1,970. I promise you guys, I can't do math in my head. And so the chances of me messing up um, some of these calculations throughout the semester is really high. Okay. And I've got nobody here helping me do the math on my own. I'm not doing it all on my own. Woe is me. Anyway, those are the first two financial statements. And again, I would normally ask if there are any questions, but obviously there won't be. So, third financial statement. The third financial statement is the balance sheet. Okay? And the balance sheet is going to have three components to it. The balance sheet is going to have assets. Assets are everything that the company, well, let me back up. The balance sheet, before I get into the three categories, the balance sheet is just a snapshot of everything the business owns and then everything that the business owes, right? Investors are going to want to know, hey, if shit hits a fan and we need to like liquidate the business, how much are we going to have left, right? How much cash do we have available to us? Like what are the things that the company owns that has value, and then what are the obligations of the business? And what's the difference? Okay? So the first category of things that we want to look at are assets. And assets are everything that the business owns that has value. And it's usually the case that the most valuable asset, cash, there are other assets such as accounts receivable. Accounts receivable is if a student came into my office, wanted to buy a hoodie. He's like, hey, I have this hot date on Friday, and I really would like to have an accounting hoodie to make a really good first impression. I would be like, yeah, that's awesome. Okay, let's sell you a hoodie for $50. And the kid's like, the problem is I don't get paid till next week. I would be okay. Actually, I probably wouldn't be okay with letting the student walk out of my office with a hoodie without paying. But that happens in business all the time, right? We are allowed to, or companies will allow its good customers to purchase products and put them on account. So accounts receivable is when a client buys something but doesn't pay for it and agrees to pay it later. That's accounts receivable. Then we have things like supplies, right? Supplies are all the things that I have that I'm gonna use in my business. I could have inventory, right? Inventory is the hoodies that I have on the shelves. If I'm Walmart, it would be the Barbie dolls in the toy aisle. But inventory are all the things that the company intends to sell. I could have land, right? Buildings, equipment. What I would do is I would open up the PowerPoint slides. I don't even remember what slide we have. Um, Hopefully you guys could see this, but I would kind of open up the PowerPoint slides, and somewhere around 46, I can't even see that. Maybe 47. Yeah, the list of assets in the PowerPoint slides, they're not great. Um, but anyway, the ones that I've listed, that's I would get comfortable with that list. Okay. The second category, the second category on the balance sheet is going to be what we refer to as liabilities. And liabilities, like the layman's explanation, those are all of the obligations of the business. Okay, so if we owe anybody money or if we are obligated to do something for somebody, that would be what we refer to as liabilities. The most common liability is probably accounts payable. And accounts payable is an instance where I go to a store and I purchase things for my business, and then I am allowed to pay for those later. Okay? The vendor is allowing me to put things on account and pay later. Accounts payable. I have notes payable. The difference between a note payable and accounts payable, note is if I'm just borrowing money, right? So I just go to a bank and I borrow some money. That would be note payable. I have salaries payable, right? The end of liabilities, there it really is no end to my liabilities. But those are three pretty good examples. Accounts payable, notes payable, salaries payable. It could be utilities payable, all sorts of stuff. Okay. The the third category of the balance sheet is what we refer to as equity. Okay? And equity has a bunch of different um, definitions, but the first definition is everything left over. Okay? So we're going to total up all of my assets, and then I'm going to subtract my liabilities, and the difference between my assets and liabilities would be what I refer to as equity. Okay? Equity has two components to it. Equity has two components to it. It has capital, and capital is all of the stuff that I put into the business. So if I want to start a business and I have $10,000 of cash and I want to put that $10,000 of cash into the business so I can go buy inventory and then I can start opening up my store with products that I'm going to make available for sale, right? I need money. So if I contribute cash to the business, we refer to that as capital. And in return, we're going to get common stock. And we'll talk about what common stock is later. But for the most part, common stock is just like the receipt. It's like the recognition that I just contributed $10,000 to the business. And the company then gives me stock that I could use to show people, hey, I'm an owner of the business. This is my business. This is the portion of the business that is mine. All right. The second category of equity is what we refer to as retained earnings. Right? So retained earnings, we just calculated in the second financial statement, and it is a component of the balance sheet. Man, it's like second nature for me to ask, you have any questions? There's nobody here. Maybe moving forward, maybe we could do this if any of you have any interest. We could do these live together. We can jump onto a Zoom call and then we can just sort of do this together. And it would make things so much easier for me because it's so uncomfortable to do by myself. And then that way you would be able to ask questions. So anyway, just I'm throwing it out there. Give it some thought. I've obviously run out of room with respect to this first slide, and we haven't gotten to the fourth financial statement yet. So I'm just going to clear this out and then quickly talk about the last financial statement. Okay, the fourth financial statement is we call the cash flow statement. And I'm just going to tell you guys, let's not even worry about the cash flow statement. It's clearly a very important financial statement. It is it's like a reconciliation of our cash. Okay. So like if I go borrow money from a bank or if I'm trying to get an investor to invest in my business, I'm going to want to have a cash flow statement. And the reason that I want to have a cash flow statement, it could be the case that I have like a beginning balance of cash on January 1st, and I could have like, I don't know, let's just dream big. I can have $1 million. And January 1st, beginning balance. And then on December 31st, I could have an ending balance of $1. Brutal. Okay. Started with a million, ended with $1. Like most investors are going to look at this and going to be like, what the fuck are you doing? This is crazy. However, it may not be so bad, right? So look, clearly if I went to Vegas and like gambled away $999,000, it'd be an awesome night, but it would be terrible for my business. Okay. In that situation, going from a million to one is bad. However, if alternatively I started the year with $1 million and then I just went out and purchased I bought some inventory. I fixed up the shop that I'm using to run my business. I bought a bunch of machinery and equipment. I bought delivery trucks. I used the $1 million to buy more assets that I'm going to use to run my business, right? Because if you think about it, if I just have $1 million in cash, there's not really a whole lot I'm going to be able to do with that, right? The $1 million in cash, I can't like bury it in the backyard and then like 2 years later it's worth 3 million. Cash is cash, and it's not going to help me make any additional money. So I need to convert my cash to other assets and then use those other assets to generate more cash. Okay, so a cash flow statement is going to just tell investors and lenders what are the things that you're using your cash for, and then what are the things that are generating cash. So the cash flow statement, it's got like 3 sections. And again, I don't really want to go into too much detail, but it's got the operations section, and that would be, you know, all of the things that we do. Like if I was selling hoodies, it's like how much cash did I generate from selling hoodies? Then it would have the financing section. And the financing section would be what are all the things that I'm like, how much cash did I get from borrowing money? And how much cash did I get from selling stock? Right? Financing would be long-term debt and all of my capital or equity. Did I sell stock? Did I borrow money? Did I pay money back to a bank that I owed money? But anyway, that's the second category. And then the third one is investing. And investing is has to do with long-term assets. Did I use my cash to convert cash to long-term assets like a piece of machinery or equipment? And to me, we have our hands full. I promise you, we have our hands full with the income statement, the statement of retained earnings, and the balance sheet. And then in addition, we're going to spend an entire week at the very end of the semester just on the cash flow statement. So I usually tell students, let's just not fuck around with the cash flow statement for now. Let's just leave it alone, set it aside, know it's there, and maybe there will be some homework questions related to the cash flow statement and do your best. But let's not waste any like intellectual capital trying to figure out or really understand this financial statement because it's just too much and we're really going to focus on it at the very end of the semester. So why bother now? To me, I feel like this is better spent in another week. But this is the cash flow statement. All right, those are the financial statements. Creating these 4 financial statements is the end game of this course. It is the whole reason that we're doing this.